Debra, I can't actually express in words what an honor it is to have you on this Voices of Impact podcast. I know you do many of these, but the importance of having you on our platform, given your history, given all that you've achieved, 30 years at the MacArthur Foundation, in many ways, Debra, you are synonymous with the whole catalytic capital. It's you, philanthropy, impact investing. It's just a privilege to have you. So thank you very much for making time for us.
Thank you, Terry. I'm excited to have this conversation. We've had some really good conversations before, but nobody ever recorded
Yes, we
them.
have.
So we get to share a little bit with the rest of the world.
It's funny because I have this idea of how we're going to avoid controversy, but I think we're going to do a little controversy, and I think that we're doing. But I want to start, if I could, I want to start with the good work of the MacArthur Foundation. Your mission statement is to build a more just, more verdant, and more peaceful world. More just, more verdant, and more peaceful. Hard to imagine anyone could disagree with that. Can you just share what has been the history of that mission statement? Because that's not where the MacArthur Foundation started. So just what has led you to these 3 points: just, verdant, peaceful.
Well, that tagline, if you will, has been with us now for a very long time. I mean, it goes back into the very early 2000s. And it really grew out of the work that we were doing at that time and the work that we've continued to do. So specific programs have evolved and run their course. And we do have a practice of bringing programs, winding them to a close when we feel like our impact and work in a field has reached its intended objectives. For example, I helped to build and then launch and implement an initiative called Window of Opportunity that was focused on the preservation of affordable rental housing. And we ran that program from 1999 until 2015, but it was structured to come to a close. And we do believe we, through our impact investments and our grants and our support of the overall field and ecosystem, that we helped to cultivate a much stronger universe of nonprofit, mission-driven housing developers, and much stronger information and research about rental housing and better policy as a result. So I do think the specifics have shifted over time. Another example would be conservation and sustainable development was one of our earliest programs and a flagship, and we were a pioneer in helping the world understand that biodiversity was a thing, was something that you could measure, something we needed to value, and something we needed to preserve. And so that was the arc of a very long-lived program. That program came to a close, but then we began working on climate change mitigation with great intensity, over $50 million a year of grants, support for work in the US and in India, work around methane, for example, more recently. And those are both green, those are both verdant, right? In our affordable housing work, we had a whole component around energy efficiency, around how could we help owners of affordable housing keep the cost of their properties manageable. One of the big ways they could do it was by keeping their energy costs down. And so you had kind of a win-win-win. It was more verdant, it was more available to people who needed it. It was more just, and it was more affordable and sustainable. So I think that these themes, just, peaceful, and verdant, they lace through the programs. We have a program on peace and international security for decades and around nuclear challenges. But many other aspects of our work have touched on the idea in Chicago, working with something called the Partnership for Safe and Peaceful Communities. So depending on where we are working, those themes come to life in different ways, but they have really always been with us. We're only about a 45-year-old institution. So we haven't had huge shifts in that time, but we certainly have had programs that come and go.
Well, when you think about it, if I got the numbers right, it's about $8 billion in disbursements over that period of time, maybe a little bit more. But if in fact you have pioneered, that's. But if you have pioneered, made such an impact, as you say, in the ecosystem for low-income housing, and then been able to move on, this gets us to this concept of catalytic capital. But I want to come to that in a second, because the big discussion I want to have with you, Debra, is the world doesn't lack for capital, as you and I know. There's lots of capital. Most of it is private. Some of it is impact. Some of it is philanthropic. But before we come to that, there are 5 big bets, if I understand, the focus is now. Climate solutions, criminal justice, local news, which I want to hear a little bit maybe more about, the AI opportunity, and Nigeria. We don't have time to do all 5, but pick one where you're doing some super exciting things right now that you want people to know about, that perhaps they don't know about.
Well, I do think the local news and the AI was literally announced like 10 days ago. And so there's tons of information.
It's funny because it wasn't there when I prepped for the call. It wasn't there, and then when I looked today, it was there.
So first of all, let me just back it for a second. Our flagship program that really is the best known, we call the MacArthur Fellows. The press usually calls it the Genius Grant. We just announced this year's class, and this is where we provide a no strings attached, sizable multi-year award to just exceptionally creative individuals that cover all kinds of fields, the humanities and science, just a huge range. And I really encourage whoever is watching or listening to this feed to go visit macfound.org, because there are videos and other kinds of content so that you can learn about and just be inspired by and be educated by these amazing individuals who are also across a lot of different age ranges and places in their career. So that has been going on almost since the beginning of the foundation. And then we are also known.
You say it's multiple years. It's like it's about $600,000, right? I mean, it's they're called the Genius Grants, but
it's got an inflation boost. That's all on the website. So
great program.
So the Fellows
Amazing
program is a flagship, and that is ongoing. We also have a program called 100 and Change, and that was created in 2015-16, and that is where we use an open call to invite proposals from organizations across the world. It's very different than how most of our philanthropy and other philanthropy is done. There are judges who serve on that open call to help share out feedback, and it gets winnowed down over a long process. We announced finalists some time ago. There will be a final award soon, and that is going to be the 3rd time that we've run the cycle of the 100 and Change. That organization will win one grant of $100 million. And the purpose of that is
I remember that now. Yeah. This is the moonshot kind of thing.
Solutions are possible. A spinoff from that has been the creation of a new nonprofit affiliated with MacArthur called Lever for Change. And Lever for Change is using that open call methodology, but to support philanthropy by others. So Mackenzie Scott used the Lever for Change platform for the yield giving call and dispersed hundreds of millions of dollars through that. So I want to just call out that the awards modality is a big one for us. And we've used RFPs and awards in our grant making and our impact investing too. The big bets that you mentioned, some of them are brand new, like local news. AI opportunity is probably in a slightly different part of the programmatic typology, if you will. And the climate solutions and Nigeria and other big bets, those were all launched more or less a decade ago. And those are all moving to a scheduled wind down. And that's all shared again on our website. So that's part of the evolution of the programs. We announced this summer, that Native self-determination is another area that we're going to start ramping up. Got a kind of fluid period of time as some of the programs that have run for a number of years come to a close. Other programs are ramping up. We have journalism and media and Chicago as what we call our enduring commitments. So those are not as programs coming and going, but their strategies evolve over time. And Chicago is our hometown, and it is where we do certain kinds of grant making, like in the arts and culture world, that we don't do anywhere else in the world. So Chicago is incredibly important to us. India and Nigeria are the 2 places where we have country offices, so we do certain kinds of work there. And I would just say that impact investments, which is the area that I have overseen,
Mm-hmm.
we are a utility player. We work with
A
any and all people.
utility player. A utility player.
The utility player, yes.
Okay, tell me.
So while part of our mission is to build the field of impact investing globally, that's technically what our
Yeah.
program is for. Um, what we are most importantly about is supporting the programmatic strategies and impact of the grant making, the philanthropic activities of the foundation. So we're working
Mm-hmm.
with the local team. We're working with the journalism and media team. We have worked with the Chicago team for as long as we've had impact investments at MacArthur. We've been working with the
Yeah.
climate team now for almost a decade. So members of my team literally embed with the programmatic teams that are responsible for those strategies and the grant making, and they co-create plans for using impact investments if and when it makes sense. Not every strategy, if all you were funding was policy analysis, impact investing is
Right.
probably not that useful. But if real estate development or small business finance, or in the case of climate, financing rooftop solar, there's lots of ways in which impact investments can take the strategy further, can mobilize private capital, can create new kinds of intermediaries. So that's our
Mm-hmm.
number one job, is to work
Mm-hmm.
across all these different programs, just peaceful and verdant, but different programs, to understand what they're trying to accomplish, and then to kind of be specialists who can come in and look for opportunities to mobilize capital, to deploy capital that is
Mm-hmm.
financial capital, investment capital. It can be loans, it can be equity investments, it can be guarantees. We have tons of flexibility, but that's our
Mm-hmm.
first and foremost job. So I'm really happy that you led with mentioning the programs of the foundation, because that's our reason for being.
Well, and I have to say honestly, Deborah, I did my homework. What you just said must be a source of great personal pride for everyone at the MacArthur Foundation. But very candidly, I don't know if the Harvard Business, case study has been written on you yet. But to be able to go into some of these areas, again, I take low income housing, and really establish an ecosystem and then move on. Say, okay,
Yeah.
this is, and the fact that you close down some of these programs to take on big ones, I think there's something really there to be studied. And I keep on asking you when you're writing your book, and you can never find time. So
I'm too
we
busy
have to
having interviews with you, Terry.
exactly. So
I want to
listen,
mention
where I
another,
sure, of
I want
course.
to mention one other field where I really believe that MacArthur, along with the Ford Foundation, was just a critical pioneer. And it was all done through
Hmm.
impact investments. In this case, there wasn't a grant making program around this. It really was all impact investments. And eventually, over the years, we were able to sneak a little bit of grant money in for convenings and networks and things like that. But the core of it
Yeah.
was making one by $1 million or more bets on a field that today is sort of well known in the impact investing field, but generally not known. And that is the field of community development finance. And the
Hmm.
institutions that we were supporting, for the most part, became certified by the Treasury much later as
Remember
community
this? Yeah.
development financial institutions, or
Yeah.
CDFIs. And I just think it's
That's
such a
right.
good case in point, because um, there wasn't a field, there wasn't a name, there
Right.
weren't any policies around it. It was really an outgrowth, in my view, of the post civil rights era. You've got all this major legislation that's been passed. And then in the
Hmm.
70s, the passage of the Community Reinvestment Act, which is supposed to ban
Right.
the practice of redlining. But the reality is that all these communities, rural and urban, were capital deserts. They had been, formally excluded from mainstream
Hmm.
borrowing and investing for a long time, which meant they were pretty uninvestable. They weren't just disinvested,
Right.
they were investable, because there was no record of what would happen if you were a lender and you loaned to a homeowner in one of these communities. You look around for comparables, you don't see anything, right? So there was
Hmm.
just a classic capital gap. If somebody didn't get in
Hmm.
there and start doing the lending, the promise of
Hmm.
civil rights would not be fully realized. but also you would never be able to bring in others who needed the data and the track record, the evidence to be able to join. So that was the essence of CDFIs in Appalachia, in South Shore in Chicago, in Philadelphia, in rural Maine, in California, all over the country. And the people who started the impact investments program at MacArthur were really, I think, just prescient and brave. And they started finding these leaders, these innovators that were almost like in the spirit of the MacArthur Fellows program. They were looking for the creative investors and lenders, and they found them all over the country, and they started seeding them. And bit by bit, get to about the mid 90s, the passage of the CDFI legislation, the Regal Act, creates a treasury designation and a pool of money, and then starts making, relative to the federal government, small grants, but they really escalated the scale of those organizations that were ready for it. I want to also note that the Sisters Religions, I know you know who Corinne Florick is and some of the others who were also pioneers in putting capital into these fledgling mission-driven financial intermediaries. We continue to work with CDFIs today in every field where we can. If there is strong CDFI, that's great for us because we can put our money in and know that other money will be mobilized. We know they're close to the ground. They can do the really difficult deal construction. And so we still work with that whole field, but our era of field building really ran from the mid 80s when we started impact investing. And then by the mid 2000s, we said, okay, $1 million investments aren't going to move the needle anymore. The field's too big. So what are we going to do next? So we created a 10-year partnership with Wachovia, which became Wells Fargo, and the Opportunity Finance Network. And then for 10 years, we made much bigger investments than we normally could have each year to try to really support the next generation of leaders. And then happily, we've seen Mackenzie Scott and others bring additional capital to the table. So that's part of the exit story, right? Is that you bring a field to a place of investability and you got to shine a big spotlight on it. And then you've got to really cultivate the conditions for others to participate. So it's been an incredibly important field. And I'm really proud of the role we've played. And it predates the kind of current program structure. So it was a program, it was an initiative. It just didn't have a name at the time. It was very much.
I remember visiting one of those early projects, actually with then Speaker Paul Ryan, Buster Suarez in Newark, New Jersey, which was really a big recipient of some of that support. But this, all of this, Debra, lets me segue to the conversations you and I have been having now for a couple of years, which is the nature of the capital markets, how they are currently allocated, and how there is, in my opinion, I think it's a shared opinion, a very latent interest desire for more capital that wants to do well and do good. Let me frame it overall. I know you know the data, but for the benefit of our listeners. Global capital markets, depending on how you define them, this is private and public equity, private and public credit. If you add in bank lending, which is, it's another source of important credit, particularly in Europe, we're actually getting close to $1 quadrillion worth of investable capital. That is 1,000 trillion. What we know with regard to the sustainable / ESG investment market, it's about 40 trillion, according to Bloomberg. The impact investment market, as defined by Jin, is 1.5 trillion. So less than 1% of investable assets are actually in impact investing. Philanthropies like yourself across the United States manage about $2 trillion in capital. Let's put that aside. But, and this is a discussion you and I have always had, I believe there is a gross misallocation of assets relative to asset owner intentions, because when ESG funds were taking in $8 billion a day, it proved people want their capital to do well and do good. Debra, people want the impact investment market to succeed. They actually want to see how it is their capital is making those changes, some of which that you've just described. And yet impact investing is at 1.5 trillion, maybe 1.6. I regard that as a failure. We need to find ways to support the impact investment ecosystem so that it can attract the types of capital that we, and you and I believe, agree is needed to solve some of the greatest challenges of our time. I'm going to pause there. That's the premise. What do you agree with? What do you disagree with?
Well, I don't agree that it's a failure. I also don't agree that I do agree that we're not done, right? There's room for more. And
Right.
I also agree that there's incredible appetite among a growing cohort of next generation high net worth individuals and family offices. We are definitely seeing a shifting and promising landscape of who wants to do impact investing. So we agree with that there's a huge opportunity that, we don't want to miss. The world can't afford for us to miss it.
Agreed.
Your comments, the setup, and now I know a quadrillion equals 1,000 trillion. So thank you for that. Because what's a quadrillion? I would say, So
it's a lot.
It's a lot. It's a big number. And I think it's really important to include bank lending because, so much of what we have done historically over our 40 years of impact investing, so much of it has been around debt, and it's been around things that banks can't or won't do, right? They won't do it, or they can't because of regulation or misperception or some combination of those things. So in a big way, especially if you look at those early years from the 80s to the early 2000s, the bulk of what we call impact investing today, and we need to do a little definition level set here, but the bulk of it was debt to nonprofits. And then some of those nonprofits were also serving end consumers with home mortgages and things like that, but they might have been financing a childcare center or a health clinic in a low-income community or financing affordable housing. But the bulk during those early years, because you can count on one hand who was doing it, it was MacArthur and Ford and Packard. Packard was doing a lot of environmental. A later cohort becomes
those are the big three, right?
At the very beginning. But then you get Kresge, Knight, RWJ, Surdna, you get many, many others. So in those early years, again, it's in the wake of extraordinary disinvestment and exclusion from the financial mainstream for huge swaths of people and places across this country. And then also in emerging markets, because of course, microcredit comes into being in this same period of time, in the mid to late 80s. You start to see TechServe and Axion and others. And then with Eunice coming to prominence soon after that. So, but those are all strategies around using debt to increase access to credit primarily for essential goods and services, including housing. So that's the field. But we need to put all of this into the spectrum that sits behind your comments, right? So the spectrum of capital goes from, fully market rate, risk adjusted,
philanthropic,
finance first, seeking full profitable returns. Don't care about impact, do care a lot about the financial return profile. So that's like in the extreme.
I would say risk return, actually, not just return, risk return, risk adjusted
return, right? So that's sitting over here. And then all the way down on the other end of the spectrum are grants. All they care about is impact. They don't need any it's a 0% return contribution. Impact investments, as we practice it at MacArthur, kind of sit another step over from the grants toward the investments. We're using investment instruments. We're making loans. We're making, we're an LP in a GPLP fund. We've done guarantees. We're using the instruments of finance, but we are impact first. So we first go looking to say, are we helping this program in Chicago or the climate program? What problem are we trying to tackle? Then we ask, is an impact investment a useful tool? And then we ask, what kind of impact investment? Is it a loan? Is it equity? Is it direct? Is it intermediary? As I mentioned, we have a lot of flexibility to work in this impact first, problem first modality with the tool second.
Right.
But we make some determination.
With your capital, not all of MacArthur's capital, but with your
So
capital.
we have a $500 million pool that is carved out as a maximum for this type of investing. Cumulatively, because the money has revolved and added up over the years, we've done close to $1 billion with the foundation's money. It comes back. We get earnings and interest. We have had losses, but the earnings have outstripped that. So we have more than preserved capital. Our goal is to be impact first, to be very deep in the impact space, and to have preservation of our capital pool. So that's part of where our flexibility for risk taking comes in, is because we're not being asked to have the same returns as a finance first investor, whether that's on the 17th building or somewhere else. And then there is just an enormous swath in the middle between impact first and pure finance first. It's all the people you're talking about who bought those ESG products and all of that. And that spans a spectrum too, right? The mission investing space, it's not a legally defined thing, but it tends to be, again, a little bit more on the edge, leaning toward impact, maybe not quite as profit maximizing in mindset. But then there's an awful lot of people who see opportunities and are seeking opportunities to have excellent risk adjusted financial returns. But as you say, they want some level of maybe not impact, maybe values alignment is a better term. Like they are looking to do investments that are not harming the planet and the people that live on it. So we've got this incredible continuum. And for us, that's also part of the opportunity, because even if our slice is small, if we use it right, we can help to unlock the capital all the way up. And we need all that capital. To your point, we're not going to get to solve any of the world's biggest challenges, social or environmental, if we're not thinking about harnessing that whole continuum. And what we have seen, and the best example is one that you know, is the SDG loan fund, which we did in 2023. We could provide a 25 million unfunded guarantee. It allowed the Dutch Development Bank, FMO, to provide 100 million in capital. And then that pool unlocked $1 billion from Allianz and other institutional investors. Without the credit enhancement, they would not have been permitted, or they would have found that making loans to emerging markets, like, to a bank in Mongolia, was not going to be something that worked for them from a regulatory and capital perspective. So what we were trying to do is take a set of lending activities and package them in a way that they were more appropriate for those institutional investors to figure out where the gaps were, in other words, and to try to bridge them with our structure, which we did. There are other blended finance examples. Not all of them are hugely successful. Some of them have a great deal of subsidy, a lot more than what we put into that transaction, and that has engendered critique. In a lot of ways, if we don't try...
I'm sorry, what critique?
There are folks that would say that some of the structures, and it's not just blended finance, it's impact investing generally, they would say you're crowding out capital. You're not crowding in, you're crowding out, because you're over subsidizing or you're subsidizing things that would have happened anyway. And that's always a discernment that we have to make. There's no science.
But it's a counterfactual. It's also a counterfactual. So there's no way.
And it's a kind of impossible counterfactual, right? And that gets me to what I would just say is we have to do things and we have to try things, and we try to be as smart as we can. And we try to learn from things that have gone before and that didn't work, and to unpack why or why not. And to just keep building our practice. So if you told me tomorrow we're at 1.5 trillion, and that success would mean we'd be at 10 trillion tomorrow, I would tell you
not tomorrow.
A way.
No, not tomorrow.
How many years?
Yeah, I think that, it's your interview, but, as you very well know, a proper growth rate, even for a healthy market, is probably low double digits, right? So, I mean, I would love to see the impact investment, and completely agree with you on continuum. We've actually never, had that a debate about that, Debra. But a very healthy market we could have the discussion. Private credit has probably grown too fast, right? So there's a big discussion right now. Private credit probably was, but if impact investing could realize somewhere between 12 and 15% annualized returns over the next decade with bumps and starts, and let me get into it specifically, because this is where I think you and I, as you know, the discussion we've oftentimes had, I make the case, well, impact should be an asset class. You have rightly countered saying, no, Terry, there are asset classes, private public equity, private public credit. And the challenge that I have, Debra, is when an investment not only has risk and return, but the third dimension of impact, we are actually now talking about a different investment. We are actually talking about a different, it is genuinely a different investment opportunity. And so where I have, and I think where you and I have had exciting conversations, is what is in fact the transparency challenge that now resides within the impact investment space, so that investors can make more informed decisions. If I'm willing to get a 4% return while I'm solving a big forestry problem and saving a bunch of species, I should be able to do that within my fiduciary, within fiduciary rules. That is a very different investment proposition than a 4% investment grade credit return. How do we elevate those discussions to scale so that every single investor, as they're speaking to their Morgan Stanley, UBS, Citibank, whoever, Vanguard person, and saying, I've got $18,000 in my 401k, I want to put this much into some impact and strategy. How do we facilitate that change, Debra?
Well, let me just say that I think the growth potential is there, but we do have to be mindful about which kind of impact investing we're talking about, because some of it will lend itself to scale at the pace and the magnitude that you're talking about, more than, for example, the extremely artisanal stuff that we do. And there is always going to be a role for deep end of the pool, catalytic, impact first investors to say, wow, there's no intermediary to finance XYZ. Let's get together with some other foundations and family offices and create that intermediary that has zero track record, right? So it's not investable, but it could grow into something. So we need to have, it's not even the venture capital. It is a little bit like the R&D capital, but it is gap filling capital. It's being a seeker of where the market falls down and leaves a space, like that SDG loan fund. So you want to have some capital that is so deeply, flexible and patient and risk tolerant that we can be on that cutting edge of bridging gaps and creating new solutions and hopefully seeding new ecosystems and infrastructure. So that's the part when you tell me, like, let's, grow at 10x over the next 10 years. Maybe not. Because I don't know, because
nor should it be linear. Nor should it be linear.
And that's going to require
like
institutional commitments and human capital and a bunch of things. We are at multiples of where we were when I started with the MacArthur Impact Investment Program 25 years ago, and when you could still count on your hands which institutions would do it. We're going to have a conference next year. Mission Investors Exchange is celebrating its 20th anniversary. We started that organization 20 years ago as the PRI Makers Network, because the only thing we did, program-related investments, is defined by the IRS. We're going to have over 1,000 people. And that was just unthinkable. And we're going to have families and corporations and community foundations. So the community has grown, and that $1.5 trillion needs to be benchmarked against whatever it was 10 years ago. And the problem is impact investing itself is a little squishy. So it's a little hard to get these numbers, and not like counting up, bank credit or something like that. So I think at the deep end, we need to, what I'm worried about, and the reason we launched the Catalytic Capital Consortium in 2019 with Omidyar and Rockefeller, and I'm pleased to say we have 10 new funders that have joined with us so that we can keep the field building and the community practice going, my worry in 2019
Yes.
was that our form of impact investing was just being denigrated as dumb money and thought
Hmm.
to not be necessary by a lot of people that really didn't know anything about what it takes to build and finance affordable housing for low income seniors. They didn't know.
Yeah.
They just assumed
Yeah.
that they would wave a wand and they would be making money and creating all this impact. Yes, there are things that can do both. I actually don't think you can maximize both. And I think you need people maximizing for impact to begin to create the conditions and the product and the pipeline that then allows those who maybe don't have quite as much flexibility on their risk or their return to be able to come
Hmm.
in that middle stage. As to the
Hmm.
fiduciary piece, I can't speak to that because I do hear people saying that they're being blocked from making the investments they want to make in deep impact first catalytic transactions, and that their trustees and others are telling them they can't do that. Um, I don't pretend to be an expert on why that is or what would take to fix it. I sure hope that if you think you can get a toehold on that and move the
We're
needle, I
trying.
it,
We are
that's
trying
not
in
been
this
historically.
administration. In this administration, we think we have a chance.
Well, that is, I think, an area that my team and we understand to be incredibly
Hmm.
consequential. It isn't an area to
Yeah.
date where we funded much in the way of research or anything like that.
Hmm.
I do have like an anecdotal sense that the barriers exist. Um,
Hmm.
my thought is we have to not only change the conditions for folks to sign on to this type of impact investing, but we also got to figure out,
Yeah.
even if they got permission, like how do they operationalize it? Because we have folks
Yeah.
coming to us all the time asking for our policy statement. How do we staff? How are we set up? How do we do IMM, impact measurement management? Because they are hungry to be able to build out a practice. And then what about all of the folks that want to do this kind of investing and they don't want to build a team? They don't want to carve out, a whole
Understood.
separate.
Com-
How do we help those folks? And so that's where more intermediaries come in and, more advisory capacity, because I see that um, as just as important as unleashing the potential is then how do we unleash the actual implementation? And I do feel like there's a lag sometimes that folks really want to do this, but it can take a very long time for it to turn into actual dollars, moving out the door. So if I'd like to see anything, it isn't so much the scale as it's the speed to bring the folks that are ready into action, because there's plenty. There's a lot of folks.
I listen. I, I actually, I honestly don't see any space between us at all on that. I'm just left with the following observation, though, Deborah. We have evaluated a bunch of micro lending funds where, their underwriting losses are lower than Jamie Dimon's over at J.P. Morgan. And to the end investor, they're returning 6, 7, 8%, and effectively, it's even a better, quality credit than investment grade, debt. And you can actually look at the human lives you've changed, Indian women that are their number one breadwinners for their families. And these stories from where I sit, I think from where we both sit, deserve a much greater, broader audience and more education and more data. And I am. I think when you and I are playing cards upstairs, after this life ends, and hopefully we've been adjudicated to get into to get the good ticket, we're going to be looking down at that 1 quadrillion and say, hey, look, now there's 40 trillion, 50 trillion that actually is dedicated to making the world more just, more verdant, and more peaceful. And I am irrepressible in my optimism in that regard. But what is so valuable, Deborah, about the role that you played now for decades, having really been in the trenches. I love your CDFI story, by the way. We need to look after CDFIs right now, as you know. But I think I'm left with two questions for you because we're coming up on time. The first question is, what hopeful prediction would you like to make about impact investing 10 years from now? What prediction would you like to make about where impact investing will be in 10 years?
I predict that catalytic capital will still be with us, that will not
Yeah, for
prove to
sure.
be just a passing, well, but that, if you'd asked me when we started our C3 initiative in 2019, I wouldn't have made that prediction. I really
Interesting.
felt that because of the fragmentation of naming, flexible capital,
Mm-hmm.
patient capital, concessionary capital, all of this, I
Mm-hmm.
really felt like the disparaging of that form of impact investing and the sense that people had who were doing it, that they were alone and swimming upstream, I think it was massive. And as a
Yeah.
result, the opposite is massive. Now that we have a
Mm-hmm.
name for it,
Mm-hmm.
over 40 different reports and
Mm-hmm.
articles, and our website where they're all stored is called the Catalytic Capital Consortium.org. So if you can type that into your
Mm-hmm.
URL, you can see all of this. But
Mm-hmm.
we have really vibrant groups from around the world that are convening and talking with each other and really getting a sense of validation in a way that
Mm-hmm.
is just extraordinary. And so I see the term catalytic
Mm-hmm.
showing up in a lot of places. So that tells me that we struck some kind of chord, that it's related to what you've been talking about. Is people don't want to think their investment is just kind of like going off into the ether and doesn't matter. They want to have not just an impact, they want to have an impact that is additive, that is doing
Tangible.
something that can
Yeah,
happen, right?
additionality. Yeah.
So
I
I
did
believe
this. If I hadn't done this, this would not
this,
have
I
happened.
mattered.
Yeah.
That people want to believe that they're not
Yeah.
just throwing their money out there, that they matter. It's the same thing in philanthropy, right? You want to know that your grant making matters. So I believe that there will be a
Yes.
space. It will not be as it is now. It is not going to be the whole of what we call impact investing, but it will be an important,
Mm-hmm.
maybe even catalytic piece. So that's my prediction. And I
Mm-hmm.
don't know
So
enough
I'm.
about
We may
what's
actually.
called impact
We may
in.
title. We may title this podcast "People Want to Matter." So I think that that's
That's
a
all we want.
that
Great.
the last question I had. The last question, Debra, is more of a nod to the next generation, which I think both you and I share a great deal of excitement about. Every generation wants to make the
Yes.
world better than it is, and yet so many of the smartest people in their colleges are going into still the Wall Street. I would love you, Debra, in your parting moments, just to give advice to young people, super smart, want their lives to make a difference, also want to take care of their families. They don't. What career advice do you give to the young people who want to be part of the do well, do good generation?
Well, I'm super glad that you've asked that, Terry. And one thing we didn't really get into the whole conversation of what is impact and how do you measure that and all that. So before I answer your question about young people, I want to say that we'll be
Second
issuing a report.
podcast.
We're
Yeah.
going to issue a report on the Catalytic Capital Consortium progress on impact, and there'll also be a perspectives piece from one of my colleagues that talks about our approach to impact measurement. And that's all
Great.
incredibly
Okay, great.
thoughtful. But I would put on top of that my own
Mm-hmm.
perspective, which is that impact is not just the things that we can count or measure or interrogate that like closely relate to the activity we're financing. So getting home loans or financing a small business or the microcredit. But cutting across all of it is helping to seed and invest in strong institutions that are mission driven, whether they're for profit or nonprofit.
Yeah.
And those institutions include things like the CDFIs
Yeah.
we talked about. There are groups that we funded when they had 10 million in assets, and now they have 10 billion in assets. And what they can do now as in their world, scaled organization with some real economic resilience is extraordinary. So we need to take the very long view about building the strength of the institutions in whichever fields we're working. I think we have to work on the fields themselves. And we talked about funding infrastructure, networks, research, policy, the things that make a field real. And I think that's within the scope for impact investors to think about when they're trying to make impact
Agreed.
Are they just focused on a single building or project, or are they thinking about also the
Hmm.
ecosystem in which that
The
and
ecosystem.
changing the
Yeah.
systems that made that project necessary?
Yeah.
But that we also must
Yeah.
absolutely be thinking about the leaders. And when I look back over the foundation's 40 years, even more than those extraordinary institutions that I can see are the extraordinary leaders who themselves were empowered to
Hmm.
innovate, grow, and solve problems and advocate and all the things because we helped put some money into their engine. And so I think that the leadership piece, it's never been more promising or important. But when I look back,
Hmm.
that's the part of the impact you're not going to pick up in, a data-driven IMM report, right? But it matters. Like,
Yeah,
who are
for
these
sure.
people and where did they come from and what were they able to do? Because a lot of these are people that could have gone the Wall Street route or did go the Wall Street route
Yep.
and then chose. I know people have done all kinds of commutes. So we have an extraordinary opportunity. We get over 1,000 applications for our one internship every summer from the absolute most amazing
Wow.
students, schools. I mean, it is
I bet.
mind blowing. And we are so fortunate to
Yeah.
be able to be in conversation with these folks. But of course, they all are trying to figure out the answer to that question like, what am I supposed to do? And a lot of them still struggle with
Yeah.
whether to go the kind of conventional finance versus now they have options. When I was in grad school, the only option was to do investment banking and go into public finance, because if you wanted to sit at the
Right.
intersection of money and mission, that was it. There was no social enterprise. There was no
That's where
impact
you
investment
started too, right? You started in Munis. Did you
in
start in
public,
Munis?
yeah,
I thought you
public
started.
finance. Yeah, yeah. And the thing is,
Yeah.
I'm
Right. Yeah.
torn. I feel like there's a ton of value doing traditional finance because of all the training that
Of
you
course.
get, and the knowledge that you get. It's just unbelievable. Um, but there are today opportunities to work with very scaled impact fund managers and intermediaries. So,
Mm.
um, there are options where somebody could go from grad school and just stay in, different pieces of the impact ecosystem. So I don't think there's no one size
Hmm.
fits all for impact investing. There's no one size fits all for their careers. I just think that one of the things that gives me the most incredible amount of hope and excitement is all of the younger folks that I have had the good luck to work
Same.
with in one
Same.
way or another. They're just
Yeah.
amazing,
Yeah.
amazing, amazing. And it just
Yeah.
fills me with such happiness to see them in the field doing their thing. So,
Well, if I may say, Deborah, I think I would advise them also to look at your life, to read the book that you're working so hard on, to describe how, in so many ways, Deborah, and I'm going to be honest with you, you have led from the front, and MacArthur Foundation has led from the front on this idea that capital can do good. Capital
yeah,
can do good, and we remain committed to the same thesis. How much more good can capital do? I think it's up to us to make sure that the ecosystem facilitates that from a regulatory standpoint, from any number of things. And our mutual friend, Jim Sorensen, as you know, continues to make great investments to advance that ecosystem. And I know how closely you work with him on many things as well,
very grateful for
Deborah.
Jim's.
So we're so grateful. Yeah. Is there anything else you wanted to leave our listeners with? You get the last word.
Well, just a big thanks, and Terry, because it's a fun conversation. I feel really lucky that you want to draw out thoughts on all of these extremely relevant topics. I can't say that at the dinner table, my family is like hankering to know my views on ESG or any of it. So it's a rare, rare pleasure. And I really appreciate what you're trying to do with this series to just, give a platform to folks like myself that are out there day to day, and we don't always get a chance to pull back and just reflect. So thank you very much for doing it. And I will just say, please look out for the impact report that's coming this fall, because I am sure you will agree with some of it and you will have suggestions. So we'll talk.
Uh, we're looking forward to it. Debra, to you and to your colleagues, everyone at MacArthur Foundation, and all those future MacArthur Fellows that are going to do more good for the world, a big thanks from the Impact Evaluation Lab. Thank you so much.
Thank you.